Hey guys, welcome to 2026. Thanks for joining me. Um, hey, don't forget if you have any questions or anything to put them in the comments. I've got the comments up on my screen. I'll reply as I see them come in. If you have any questions or anything you want to talk about, hope you're having a good New Year. Hope you had a good New Year, good safe New Year's Eve, and looking forward to 2026. So today I'm going to be talking a little bit about some speculation as to what 2026 might look like for real estate investing, primarily multifamily investing, and just kind of how we should orient ourselves, what we should focus on, what we might see, what we might expect. I have a video I want to show you later on from Ken McElroy, who kind of gives his prediction for 2026. And I think it's pretty good. It's pretty high level, kind of more for larger operators. But I think there's a lot of good things in there, just principles wise, and that even apply to some of us who are maybe buying smaller properties, maybe fourplexes, eightplexes, things like that, getting into our first investment. Things that to just warn us that, not to jump into anything too hastily and things like that. I think that 2026 could have a lot of good opportunities, especially in more larger urban areas. That's usually where the corrections and things happen quickest and are the most dramatic. So if you live in any areas like that, then definitely keep your eye out for some good deals. So what's likely going to happen, in my opinion, is that in 2022, 21, 22, people took out a lot of low interest rate debt, and they were banking on being on cash flow increasing, so that in the 3 years when they needed to refinance, that they increased net income would be able to cover the increase in their loan, because the rates went way up from 21, 22 to now. They doubled, more than doubled even. So they're looking at a huge reset in their mortgage payment, especially on large properties, but even on small properties. And a lot of these owners are going to end up being forced to sell or put money in out of their pocket, because the lender is going to require it, or whoever the equity partner is. This is going to affect all kinds of things like syndications as well. So if people didn't buy properly and they bought at the top of the market with the low interest rates, but for a high price, they have these massive loans, they will feel a lot of pain in 2026, because rents are at best flat and falling in many cities. And part of that is due to, I was just reading the other day a stat that 60% of the rent increase was due to immigration. And so we're probably going to see some of that go down, especially in these urban areas that have a lot of immigrants and had a lot of immigrants. As obviously there's fewer people, there's going to be less demand. A lot of the demand was driven by immigrant populations. And so that means that in 26, most likely rents are going to drop, which are going to give the owners less net operating income, obviously. So they're not going to be able to refinance their loans, because they're expecting them to go up so much, the rents up so much. And so it just opens up an opportunity for those of us who are looking to buy. Now, it's not going to happen right away in 26, or maybe halfway through. We're probably talking more towards the end of 26, because the screws are going to have to be tightened pretty tight for people to start lowering way down their asking prices, and for them to get pressured by their bank, and for them to consider selling at a loss or a strong discount to what they're currently listed at. So I would say, as I've been talking about in my buy or burn videos, where we analyze properties, you really need to be able to analyze the operating memorandum, and you really need to prevent yourself from being sucked into pro formas, because these pro formas always over exaggerate what the performance of the property is going to be. And this is a bad thing in 2026 because they always think, the rents can go up 10 or 20%. So then you're going to make all this money. Well, and I've been warning you guys about this and saying, nope, just go off of what the actual numbers are right this moment. That's what you really want to go off of. Okay. Because you don't know what's going to happen in the future. And if rents stay stable, then this property makes sense. You don't want to bank on buying a property that the rents and hoping that the rents can go up. You want it to be able to pay for it 100% financed right now with the current rents. And then if the rents can go up and if the interest rates do go down, then that's all benefit for you. But we're not going to speculate and buy based on speculation like that. That's what these people who are going to be getting underwater now have been doing. They were speculating, hoping to make huge net worth gains as the rents went up, and then they were going to sell now. But now it's not working out for them, so there's going to be big losses coming for them. So, like I always say, be really cautious with the pro formas, with agents and brokers that are telling you, this is how good this thing's going to be. This is how much more rent you could make. This is how much better you could operate it than the current operator, right? Why would you be able to operate it better than the current operator? That doesn't really make much sense. So you need to just be realistic about these things. And if the property is overpriced, then it's overpriced. And we don't move on to something else. And if people tell you that your expectations are too idealistic and too high, then they just don't really know what they're talking about, because this is how you get a deal that doesn't get you screwed over in the long term. You need to make sure that the current rents are paying and will fund and finance this thing 100%, hopefully with even a little bit of cash flow, so that you can put that away for repairs that are inevitably going to happen. But you also want to make sure that you're getting debt that's hopefully long-term locked in debt. And then you can refinance that later. But this is what's really getting these people into problems. And just like 2007 and 2008, it was the interest rate adjustment. It was because they had low interest rates and the rates went up. And when it came time for the rate adjustment, they were underwater. They couldn't afford it. The payment was too high. So this happened to tons of people who had bought multiple properties, second homes and stuff like that. And so they all went under and pulled the whole thing down. Now, I don't think we're looking at anything extreme like that, but we are looking at a buying opportunity if we play our cards right and if we pay attention to what's really going on. So we can probably focus on places with growing populations, with good schools, good neighborhoods, good incomes, and all that kind of stuff. Those are going to be really stable markets, and they're probably going to be able to find a deal throughout the year. So that's what I would have you focus on. Now, in smaller markets, like let's say 100,000 or lower, there's not as much fluctuation because those are relatively stable markets. Places like Miami and stuff like those things are highly volatile, and they move rapidly and a lot. Now, in a small rural town, prices aren't going to fluctuate all that much, and they're based primarily just on the interest rate and stuff like that. So it's not as big of a deal, but we still need to be cautious and we still need to pay attention. Now, the ideal would be to get something that the buyer is underwater or distressed or has to sell. So you have yourself a motivated, or the seller, I mean. So you have a motivated seller, and that there's some kind of value add still for you. That's what that's like the ideal scenario. So that's what we'll be looking for in 2026. If you guys have any deals you want me to give my opinion on, you can send them to me. My email's in the description on YouTube. If you have any comments, post comments and let me know, and I'd be happy to engage with you. I read all the comments. If you guys would like this video and subscribe, that would be fantastic. You get updated on when I go live and when I post new videos, and it helps the channel grow. If you have any comments, go ahead and drop them in on on here, and I will be happy to answer and give you my opinion. And so in 2026, I'm looking to buy. That's my goal. I'm hoping to buy. I'm hoping to find a good deal. I'm not going to overestimate what my rents will be. I think rents will stay level to drop over the next few years, especially if deportations increase as much as people are expecting them to, because immigrant populations are largely renters, and so that's going to open up a lot of apartments. There's going to be more competition going on for renters. It's going to be more of a renters market, I think, in 26 and probably 27. And then by the end of that, all of those people who are underwater and whose asset or whose loans are resetting and stuff, they'll be washed out of the market, right? So as rents are falling, people are not going to be building a lot of new apartments as a result. And so at the end of 27, we'll probably be adjusted mostly to where things have stabilized, and people will start building again, and then we'll build back up towards that. These are the cycles of real estate, how they work. So nothing to be fearful of, but definitely something that could be an opportunity. Prices have gone up like crazy. As over the last 10 years, they've just been going up and up and up and up and up. So this is, I think, kind of a cooling off period, and you should just keep your eyes open, keep your eyes peeled for a good deal. And like I always say, make sure when you read the pro forma that you're very conservative and you're very skeptical. One other thing to keep in mind: the expenses are never going to go down. If the pro forma says that the expenses when you take over are going to be less than the expenses that they currently have, they're lying to you. They're trying to deceive you. The expenses are not going to be lower. And then in the next year after that, the expenses are going to be higher again. Okay. So you really want to be suspicious of the pro forma. Okay. Now, the best way to probably find a deal wouldn't be something that's on market, obviously. So if you can make some relationships with people and go to groups and sort of find out who's selling and what's going on in your market, then that would be ideal, because you could find probably a better deal that way than if you just look at apartments.com and Zillow and things like that. So those are usually the lesser deals, the off-market deals. If you know what you're doing and you know how to analyze a property and you know all that kind of stuff, then the off-market deal is not scary. What happens a lot of times is, even on off-market deals, people overinflate the value of the property. So just because it's off-market doesn't mean that it's well priced. Okay. Doesn't mean that it's a good deal just because it's off-market deal. All right. So there's plenty of off-market deals where the seller is completely delusional and thinks that they can get, $1 million more for their property than what it's really worth. Now, that's where you, as the expert investor, come in. You have to be able to take their information, their rent roll, their expenses. You have to be able to calculate that to see what kind of valuation the property should have. And you need to be able to evaluate what the seller is leaving out, because when they give you their expenses, they're gonna leave some things out. They're not going to be completely honest and upfront with you. They're probably going to not be counting their own labor as an expense. For example, if they mow the lawn or if they do some repairs, they're not going to include that in the expenses, but that will be an expense for you. Okay. So you need to add that back in. Then, they might say that the rents could go up, but then you always have to ask, well, then why aren't you raising the rents? Because you just don't want money? Of course. So just assume that what the rents they're getting now would be the rents that you would get, that the vacancy rate, put that at a reasonable vacancy rate. And, hopefully you can find a deal. And especially if you become a person who people know in real estate, in your local real estate world as somebody who's interested in buying, and you have a plan to buy in 2026, then they will come to you with deals if you make enough contacts, because it's much easier to just deal directly with the person wants to buy. And so you can maybe get some deal flow that way, and you might get a little more insight that way. You could find out from the seller, you know, if their mortgage is underwater. If it's not, is it a good mortgage? Is it assumable? Could you take it over? And if it's a good interest rate, um, you could keep that same loan that they have at their current terms. So those are some of the things that I would recommend for 26. Um, Now Ken, he recommends a lot of the same things, I guess, but he gets into a lot more um, large overview, kind of um, little more abstract, little harder to understand. But so I'm going to comment a little bit while he's talking. But I think we should be excited about 2026 if we play our cards right. We could get ourselves into something really beneficial for us, especially if you live in a higher population area. I think that there could be a lot of good deals for people in those areas. So I would recommend you put in a lot of time this year, um, making relationships with people that are investors in your area. See what they're hearing, what they're thinking, what they're expecting the market to do, because those investors in those local markets are the most knowledgeable people in the market. If they're a real estate agent but they're not in rental real estate, they don't really know the market. It's the investors who know the market. They're the ones have the most need to pay attention closely to the market, and it is their market. And so you want to make some relationships with the local people. You can make and talk real estate with people that don't live in your local market, but I would recommend more so focusing on the people who do live in your market, so that you can collect really solid data that is really useful and helpful for you. Because the last thing you want to do is make a mistake in buying something that you're not going to be able to sell, or you're going to sell at a loss if things get tough, and you overestimated the income, and now you're in a bind, and the bank is not happy, and they're forcing you to sell, and now you got to sell at a loss, and you have to eat the loss. Now you just lost $100,000. Like, we do not want that to happen. Okay, so that's why it's so important when you're looking at buying something, you really understand the numbers and the calculations and how that all works. And that's why I do the buy or burn videos, to try to lead and guide you guys through a lot of that stuff, so that you can become experts at reading the numbers, so that you can get into a really good deal, so that even if something bad happens and you have to sell, you're going to sell, and you're going to make money, so that's the goal. And that's how, I consider myself very conservative when I do these numbers, but I think conservative is the only way to make money long term in real estate. You don't want to buy at the height, you don't want to speculate, over project, and all this kind of stuff. Yeah, maybe in a fast moving market, in Florida, in Miami, you can make some money some years by flipping them like that and taking the equity, but I don't recommend that. I'm not interested in that. For me, this is about wealth building. It's about long term excuse me, it's about long term wealth building. It's about establishing a lifestyle that you're wanting to establish, with financial freedom, with cash flow, with all that kind of stuff. That's more of my focus. It's a much simpler, easier focus, and I think it's a lot less stressful of a focus. And so this is possible, and 26 is going to be a year where you can get started on this stuff. So I think that, people talk about prices being so high on everything, and interest rates so high, but that's what's going to lead to our opportunity in 2026. Okay. Okay. All right. Well, now let's get started on this video here, and I'll just interject my comments here and there while we're watching it to kind of give my opinion. But this is Ken McElroy. I'm sure most of you know who he is. He is he's the rich dad, poor dad guy. Basically, Robert Kiyosaki invested his money with Ken, and Ken grew his portfolio like crazy. So I think he says he has 10,000 properties that he manages or something like that. So he's a guy who's been around real estate for a long time. He's got some really great books on real estate, of like understanding real estate. So I'd recommend basically any of the books that he's written. He's a real, you know, down to earth, solid guy. He's not doing anything crazy. And he's been in the business for who knows, 30, 40 years, 40 years probably. And so he knows what he's talking about. He's an authority, somebody you should listen to and take seriously. And so that's what we're going to do here. So let's get started here and see what he has to say.
The best real estate strategy for 2026. 2026 market is coming. So everyone's asking, what is the move for 2026? Buy, sell, wait, refinance. But here's the thing. 2026 won't be like 2020. It won't be like 2008, or it won't even be like 2024, just a couple of years ago. So we're heading into a very different kind of real estate market. And if you don't adjust your strategy, you could lose big. This video is your playbook, and this will be the best strategy that you will find on building wealth in the next cycle. And it's not what most people are going to be doing. So there's a wave of loan maturities coming in 2025 and 26. If you don't know this, you should just Google it. You'll see billions and billions of dollars in commercial and multifamily debt is set to reset at much higher rates. And what that means is it means that the loans are maturing or the equity wants their money back.
Now, I know that's kind of an abstract, kind of difficult to understand idea, like where are these loans? Who are these loans? How do I know which ones? All that kind of stuff. But it's just kind of a bigger picture kind of idea that this is going to lead to there being deals, and it's going to lead to more selling by owners. So a lot of these real estate loans are not fixed rate, they're adjustable rate. And that's essentially what he's talking about. Or they're getting like a short-term bridge loan, or there's a lot of private lenders out there who will do these short-term loans like this because they're just like equity groups. Okay. And I get contacted by these people all the time. And so what they'll do is they'll offer you short-term loan. Maybe it's 100, 90%. And then they also finance in the payments for 2 years, like these crazy deals. So your loan is actually high, or higher maybe even than what you bought it for, because it's got these other interests and things factored into it. And so those are highly risky loans. And that's why I don't recommend anyone really does that. But then when the equity partner, the equity group comes due, your contract is up, and they're like, okay, this is our money that we want back. So you've paid them and paid them and paid them, and then you basically are still underwater because the value of the property hasn't increased as much as you expected, nor have the rents. So you just don't have enough cash flow to meet the consequences, or to refinance it with another bank and meet the DSCR, the debt service coverage ratio that banks require, which is usually 1.2, 1.25, which means essentially they want your monthly cash flow, or your monthly, I guess it would be your net income before your mortgage payment. They want that to be basically 20 to 25% higher than what your mortgage payment would be. So you pay your mortgage and you still have 25% more cash flow left over. So anyway, these are kind of abstract, kind of abstractions we're talking about here, these loans and the maturities and all this kind of stuff. But basically all that I wanted you guys to know is that this is a similar situation to 2008, where the loans matured and basically the rates adjusted then, and that's what it was. And so then a bunch of people couldn't afford them. This is something similar, but basically just wanted you to think okay, well, we'll keep our eye out for properties then that maybe this is what's going on.
So what is the result of this? Number one, a lot of over-leveraged investors are panicking. They're running out of cash. Two, forced sales are now hitting the market. We're seeing a flood of assets hit the market, which is actually good if you're a buyer. And three, valuations, as most of you know, have already corrected, but they're continuing to correct. They're going to crash in some market.
Okay, so yeah, we're starting to see some of this correction. Probably in the bigger, more quicker moving markets, they've already corrected, but I would say in like the Midwest, they are continuing to correct. They have not corrected much at all. But they're going to continue to. Now, they're not going to correct as much as on the coasts, but they're still going to correct. So, a lot of leverage. His number one, there are a lot of over leveraged investors are panicking because they're running out of cash, and that's kind of what I was talking about. That as their loan is higher, so a lot of times when these syndications, when they put together these groups, they have a cash reserve. So they might, buy a $2 million property, but they have a $200,000 cash reserve. So they get more investors and more money than what they actually need for the property. So they have this $200,000 pile of money that maybe they're going to use for repairs or whatever. Well, as their loan is, their rents aren't going up as much as they expected them to go up. Now they're running at a negative. They're running in the red every month. So they're pulling from that $200,000. And that's the cash he's talking about. They're pulling from that $200,000 to subsidize their month because they're not able to push the rents as high as they expected to. So they're dwindling their cash. They've been doing this for maybe a couple years now. So they're running out of their cash. And now they're like, what are we going to do? And you're not going to be able to bring in another injection of money from another investor, because who would want to invest in something that's losing money all the time? The people who already invested, they gave them great returns, and this is what your internal rate of return is going to be in your cash on cash. We gave them all these speculations. Well, those people are not making any of that money. They're burning through their cash, and so now they're getting at the end of the cash. The banks don't want to give them loans, so the only option would be to sell the property and give everybody back as much of their money as they can. So those are also then the forced sales that he's talking about. So
you've heard a lot about the loan maturities in 2025 and 26, but why does it matter so much? And what are we seeing on the deals that we're looking at? There's plenty of horror stories, and I'll just give you a couple examples. So there's regular lenders that are regulated, and then there are debt funds. And both of these are trying to work with various borrowers. But on the deals that we're starting to see, we're passing on many deals where the loans are actually worth more than the value of the property. So,
I mean, how sucky of a situation would that be in? The loan is higher than the value of the property. Man, I'd be sweating like crazy. I would be so stressed out. I would not like that at all. And that's what happens when you're sort of like a speculator, not really, you're not buying it. A lot of times these are groups, and they're trying to get this reserve, or they're trying to get this return for their investors, and it just doesn't work out. You, though, as a person, as an individual, you're not going to be a dumbass like that, and you're not going to make these stupid ass decisions, because it's your money on the line and it's your future on the line. So you're much less likely to get into this kind of a scenario. But this is what happens, especially in these big markets where the prices, the values of real estate fluctuate wildly. And so they've got loans that are maybe millions of dollars more than what the property is worth. So when they sell this property, the investors have to put money in to pay off the loan. What a shit show.
What happens in that case? What's happening is those groups are working with the existing and the original borrowers to try to see if they can hold on through this period of time, hoping, of course, for lower interest rates, lower cap rates, lower expenses, all of which is not going to come anytime soon. So if you're prepared, this is going to be a huge opportunity. Mm-hmm. But if you're not, it's definitely going to be a risk. Finally, 2026 is going to separate the speculators from the operators, because in this case, and in all cases, operators always win. So what this period of time is going to do, it's going to reward the disciplined underwriters and the long-term thinkers and the ones that underwrite these deals correctly. So most of the last decade was driven by appreciation. You could do anything you wanted and things are just going to go up. And so everybody believed that they were these great real estate investors. Well, this is all coming to fruition. Buy today, sell tomorrow for higher. Well, that game is over. So the winning.
Now, he's not necessarily saying that real estate's going to stop appreciating, over 10 years and things like that. He's talking about a very specific kind of investment that happens mostly in larger cities that have rapidly increasing real estate values, that people buy just in the hopes and just in the expectation that the appreciation will be rapidly, even if they're okay, I know to me, this is a crazy way to invest, but even if they're subsidizing the property every month, as long as the appreciation is outrunning that, which a lot of times it was, so you're making an appreciation on a couple $1 million property, and even if you have to pay $1,000 a month, you're still ahead by the end of the year. And that's the kind of game these people are playing. And so he's not saying that you, as a normal human who's not a crazy psycho like that you're going to buy something that you want to be stable, and that you want that with these cash. And this is the principles that I've been teaching you guys. The cash flow that you currently have can pay for everything. All right. That property is just it's going to hum along. It's going to appreciate at its little bit, 3% every year. But these people had properties that were appreciating at 15% a year. Right. And these are the kinds of projections that they are putting in there. So that's all coming crashing down. But we're not looking for that kind of stuff. We're looking for a property that pays for itself, the cash flows that, and then one of the benefits is the appreciation over time and things like that. So this is why he's calling these people speculators.
Play in 2026, cash flow. And it always has been cash flow, but we just got away from it because people were chasing capital gains. So now, as always, even more important, you need to buy assets that pay you today, not later. Yeah. So at MC Companies, we're focusing on Class A and B properties in really strong markets. So what does that actually mean? We're looking for high job growth, high population growth, great schools. We're looking for low government regulations and safe.
So he's looking for everything. Yeah. So, yeah. This is going to be a lot of, the better areas of most cities, probably more so Republican leaning states. And so he's probably talking about places like Phoenix and Houston and Dallas and, places like that have these pockets and these areas where they have low government regulation, but then they also have these really high concentrations of good schools where people are moving there from California, and it's growing the population like crazy. So there's always this rent demand, and there's lots of jobs there because these are really vibrant economies. So
that's where people are going. People vote with their wallets, and that's where they're headed. They're going to go where it's safe, affordable, the weather's great, and more importantly, where it's easy.
Florida.
They don't want things to be hard, especially financially. So we're underwriting, focusing on realistic rents based on actual collections. And we're heading into a period of time of softness, which basically means it's going to be the time of the renter. The renter's going to have lots of choices. So the great operators are going to rise to the top here, but you have to underwrite correctly. You cannot underwrite rising rents during this period of time. And lastly, of course, fixed rate debt. Now, you can always refinance going down, but what you really want is to be hedged going up because we don't know what's going to happen with interest rates. So if it cash flows today using these principles, you're going to be fine. So in a high rate, low growth environment, the only safe bet is going to be yield. And that's cash flow right out of the gate. So what's interesting is there's going to be all kinds of disruption during this period of time.
So he's talking about cash flow right out of the gate. And that's, what a lot of what I'm talking about too, with the 100% financing. If you can find a property that can finance itself 100%, and after all the expenses and all the costs, it still has money left over, then in my opinion, you have cash flow. He might be including the debt service as part of the cash flow. I'm not sure exactly what he means, but if you can get a deal like that, you're golden. And as we've seen in the buy or burn series that I've been doing, there's almost those properties still, there's not a lot of those. Okay. So the market still needs to go through the correction. There's still people who are wanting you to buy your property and lose money on it every month. Right. So these people, they're out of touch, and nobody's going to want to buy those properties. And can make you feel a little crazy sometimes that your standards are too high because all these properties fail the test. But don't let that get into your mind, and don't let it fool you. These properties are out there. They've always been out there. They always will be out there, and you can find them. So don't get overly anxious to buy one and to screw yourself over at the buying. But when you do find a property that meets the criteria, make sure you go super aggressive to get it, because they're so rare and they're difficult to find.
Of course, there'll be other kinds of asset classes that you'll be able to look at. As you guys know, one of those asset classes is billboards. Boss and I are looking into billboards right now. We love this asset class because there's not a lot of people involved. It's basically a flat screen in the sky. It's technically real estate. We get 100% bonus depreciation because it's considered a land improvement, and it's long-term leases, like 25, 30, 40, 50-year leases even in many cases.
Yeah. Anybody out there in the billboard business or looking to get into it? Sorry, I can't help you with any analysis of billboards. I'm not sure he kind of brought that. It doesn't really fit with what what he's talking about. So he just kind of throws in this billboard thing. I don't know, maybe to advertise for it or something. But I've never heard anyone say that they're looking to get into the billboard business. And this is kind of strange, because how many billboards would you have to buy if you have 10,000 units, and you got this cash flow? How many billboards would you have to buy in order to make a dent in your assets? Like, he must be buying billboard companies in large towns or something where you're getting 1,000 billboards at a time. I don't know, but I thought that was kind of an interesting little interjection there that he had about these billboards. I was like, whoa, what? Billboards? Who invests in billboards? Can you get a loan from a bank to buy a bunch of billboards? How does that work? So
really, really good, low operational type assets that produce cash over the long haul, and of course have great tax benefits. So how to find deals in 2026. So like any time, distress creates opportunities, but only for those who know how to spot it. Now, in 2008, of course, we went to the banks. Right now, people are trying to do deals with the people that are in trouble, and that's fine. But we don't know how far this is going to fall. And the last thing you want to do is catch a falling knife. So here's what we'll be looking for. Number one, owners with loans that are coming due. Now, that could be in the form of a bridge loan, a regular loan. It could be in the form of even equity partner. Doesn't matter.
So I've heard that there are websites that you can find out what mortgages are on real estate property. I don't know if that's the case or not. If anybody does know, please comment and let me know what kind of websites maybe you found that information on. But really what he's talking about here is he's talking about making relationships with, local banks, local lenders, a different kind of equity partners, making relationships with these people, going to conferences, talking to the people, the bankers who show up to the conference, and inquiring as to if they have any of these kinds of assets. That's really where he thinks you can find these things. So then it's really about networking and making relationships. And so then you maybe, it's a bunch of bankers from one state who go to their annual conference, and you go there and you just talk to them and you're like, I'm really interested in getting into something. Do you guys have any that are distressed assets? And the banks, they don't want to deal with the whole process. They're not in the business of owning real estate. They're in the business of of lending money. So they are happy to just say, okay, yeah, this is the deal. And, can we make this thing work so that they don't have to try to sell it on the market and negotiate the price and do all that kind of stuff. So it's in their best interest also to have somebody that they can just sell it to. So
the people that want their money back, regardless of what the value of the asset is today, and that is the opportunity. Because in many cases, the loans on these assets are actually worth less than the values today. So number two, we're looking for syndicators who can't refinance or raise capital. Now, this is a lot of people right now because, of course, why would you invest in something where the loan is more than the asset itself?
Exactly.
So raising capital right now to try to save deals or rescue capital, I guess it's called in many cases, is basically at a standstill right now, unless, of course, there's equity. And in some
Well, that's what I was saying earlier. This is why after they burn through their pile of cash in these syndications, they can't raise any more cash to keep subsidizing the asset that's losing money every month. Because what kind of an investor would want to invest in something like that, right? Where basically 25% of the cash you're investing is just going to subsidize this every month, and then the value is less than the loan, so there's no upside for you. So
Cases there are, but in most cases, there just simply isn't. Then, of course, there's mismanaged properties with upside in operations. So just last week, we looked at a property that was brand new, almost fully built. The guy ran out of money and it was 50% occupied. So basically, he's suck and win hard. And you could tell because at the end of the project, there were some construction costs that were clearly cut back, but also sitting at 50% occupancy does not pay the bill because you have your debt plus your expenses. And after that is cash flow, and 50% occupied doesn't even cover both of those. So in that particular case, the owner is funding it each and every month. Those are the kinds of deals that you want to try to cut. Yeah. And then, of course, the low-hanging fruit is always properties that have been sent back to the bank, but only if the bank now is realistic on exactly what the value of that asset is. Because in many cases, the banks are trying to sell those for the loan amount, but in many, many cases, these properties are valued even below that loan amount. So now you have to negotiate with the bank, just like we had to do back in the 2008, 2009, to try to get them to do a write-down on the original loan that they made. And that always can be a little more difficult. So you want to look for tired landlords, burnout operators, people who got in at the peak and they want out now. And that's all timing based.
So this reminds me of something that I like to tell, some advice that I like to give people, to look for properties that try to find properties that have owners that are older. He mentioned burnt out operators, and a lot of times those are the older people. They've owned this property for 30 years. They've been dealing with renters for 30 years and broken shit and leaking sinks for 30 years. And they're 60, they're 65, they're 70, and they're just tired of it. They want to be done. And they're just like, I just don't even want to do this anymore. Now, that is a great buyer, especially for a young person who's looking to get into it, because they tend to have a lot of equity in the property because they've owned it for so long, probably paid off their loan. One of the things that is frustrating them probably, or would me if I were them, is that they'd no longer have depreciation against the property because it's about 27 years and it runs out. And so now they're paying full tax on all the income that they're making. And they have this, maybe $1 million or $2 million property sitting there that they can't do anything with that money because they don't want to take out another loan to get that equity out. So anyway, they're kind of at the end of the game. They're kind of at the end of what they had hoped to achieve. And they usually are they can be, usually in my experience, they're pretty easy to work with, and they enjoy working with maybe some young person who's just getting started, right? And they know that they can help you out. And so you can sometimes make some pretty good deals with these older people because they have so much equity in the property. So sometimes if they have multiple parcels, like let's say they've got a fourplex that's on a separate parcel and another fourplex on a separate parcel, what you can do there is you could maybe negotiate taking over running the entire thing. Okay. So you're collecting all the rents, paying all the bills, operating it. But you buy the first parcel 1 year, and you buy the second parcel the next year. Okay. So not only that helps them with their capital gains because they're not paying it on everything all at once, pushing them up into a higher tax bracket. So if you buy the one parcel, you've only got the loan now on the one parcel, but you're making the money off of both parcels. So you get a infusion of cash that first year, okay? Because you don't have a mortgage on the other one. That's all, you're keeping all that cash. So then in the second year, then now you can show the bank, whoa, look at how good I am at operating this. This was the plan. Everything's working out the way it does. I have a $20,000 reserve account because I was able to keep all the money that I was going to pay for the mortgage. So, and anyway, things like that. So that's a good scenario. Or seller financing. Older people, they if they don't have anything to do with the, let's say, $1 million, maybe they would just let you borrow 250,000 of that, and you pay them interest or do interest only payments or whatever to help fund their retirement. So not only are they making $1 million ultimately, but they're also making that interest for, let's say, 5 years off of the 250,000 that you're borrowing from them to use as the down payment on the loan to give them their $750,000 cash, if that makes sense. Did I make sense how I said that? So I think that this is a good opportunity. And a lot of these properties are owned by older people. They bought them in the, 80s when they were super cheap, and this is what they've done. And now they're ready to be done, and they're tired of the headache, and they're old, and they can't do all the stuff that they used to be able to do. And they just want to go to Florida or something, So if you can, you can call around. What I recommend is, go on Google Maps, look at the property sign, get the number. If it's a smaller complex, it's or even look in, classifieds or on whatever, call the properties, and you're probably going to get the owner on smaller properties because they're just managing it themselves. Okay. And so then you can talk right to them, see what they have planned, and if they're interested in selling, or when they are interested in selling, if they would contact you and you really like their property and are looking to get into real estate to build your future, and you admire what they've done, things like that. So there's that's a really good way to get in if you can find someone like that. And they tend to work with you and be generous as well in the process. And it ended up being a win-win for both parties. So
the best thing that you can do right now is to work on your broker relationships right now and to build your lender network. Because if you build your lender network, you're going to start to hear about deals that they're dealing with as well. But also the brokers are all over some of these distressed sellers. So you got to build those relationships now. So if you haven't, now's the time, because the best deals in 2026 are definitely not going to come from the internet, and they're certainly just not going to show up in your inbox. They're going to come from relationships that you build today or ones that you had yesterday and that you continue to nurture. So I've been asked, how do you build those relationships? Well, it's easy. Like, there's annual conferences, there's monthly conferences, there's Zooms, there's coffee, there's happy hours, there's all kinds of stuff. You guys just got to take some effort. Call up these guys. Usually they're the ones banging on your door. Just reach out to them. And most of the time they have a pretty good pulse on them.
Well, also another reason to make relationships with these people is not just to find deals, but also when you go and you're looking for financing, and you find a deal and you want financing, now you have relationships with bankers, because bankers are your best partner in real estate. You need them. They need you. They are, sometimes tough to work with, and unreasonable, but you can usually, clarify things, explain things. You can talk to the committees. You can talk to the president of the bank. You can, you can make your case, and once you make your case and once you get the money, they are the best partner that you will ever have, because they never ask for anything again as long as you're keeping up on your payments. They give you the money, you get the property, and then they go away, unless you get a government loan or something like that. But they don't get any of the appreciation. They don't get any of the increases that you get from rent rolls or from, maybe putting pets in there and getting pet fees. They don't get any of that stuff. They don't talk to you. They don't bother you every month. They don't, they're gone. So they're great partners, especially once you establish a good relationship, and then it's much easier to buy the next one, and it's much easier to buy the next one. So not only is this is networking like this a good way to find deals, but it's also a good way to start that relationship, because your banker relationship is a personal relationship. And, and if you can start off with a good one before you even need a loan, then it's just more likely for you to get a loan. These bankers are not necessarily basing their lending off of hard numbers. They're basing it off of their relationship with you, and whether they think they can trust you, and whether they think that you're going to come through on what you say, and then kind of on some of the numbers and things like that, because they have to kind of justify their decision to the committee if they're going to lend to you. But it's heavily relationship related. So definitely make relationships with them.
And then here's what I suggest that you avoid. So just as important as what to do is what not to do. So in 2026, here's what you need to avoid. You need to avoid overpaying based on pro forma rents or something that could be had in the future. You want to avoid that at all costs. And that also includes vacancy. You need to budget for higher vacancy and high concessions because we're heading into 26. It's definitely going to be a renter market. The renter is going to be the one in control, and landlords are be scrambling to try to get whatever renters they can using rent concessions and heavy marketing costs.
Yeah. So this is what I've been basically saying too, is that, these, I think it said on that slide, performer, right? Did it say performer? Anyway, pro forma costs, pro forma income. You don't want to base any of your buying on that shit. Okay. Total bullshit, totally made up, total nonsense. It's basically just lies of somebody that made up who's not even probably a real estate investor. They're just, yeah, we're going to pull shit out of the air, based on comps that probably aren't even realistic comps. So just pro forma stuff is not something that you even want to pay attention to. You want to look at the actual numbers. And he's saying that those numbers are probably even going to drop in 2026. So if you're looking at 2025 numbers or 2024 numbers, sometimes they give you, maybe even assume a little bit of a discount for rents or higher vacancy rate than what they were giving. So what they're going to try to value it on is overinflated rents, underinflated expenses, and then they're going to come up with a value. Well, your value is going to be wildly different if they're doing that. And they're going to sit on that property and hope that a sucker comes along and overpays for the property. And I don't think that there's going to be many of those people in 2026. So
2, do not bet on rate cuts.
Okay. Yeah.
We already got into this, guys. We saw when rates went up. This is exactly why everybody's in the situation right now. You want fixed rate debt today. You want cash flow today. If you have rate cuts, then that's just a bonus for you later. Yep. But do not put it in your business plan and do not bet on it. Third is.
Yeah. So I'm guessing that there probably will be rate cuts this year, but don't plan on there being rate cuts and being like, oh, well, I'll lose money for maybe 6 months, but then the rates will be down. So then I can refinance. And then if I do refinance, I'll be making money. You don't want to do it that way. That's way too risky. You want to just, based on the current rate, locked in. And then if the rate goes down and you refinance, it's just extra money to you.
Taking short-term debt. This seems rather obvious. Do not do that, you guys. Short-term debt usually is not fixed. It's usually floating. And we have no idea where rates are going to go. And you're going to want to underwrite it at today's rates for sure. And do not anticipate some kind of exit in a short period of time at this point. Yeah, these are long-term holds and you need to ride this out. And then, of course, be careful on buying in oversupplied markets. However, these can also be great markets to watch, and they can be opportunities for later because oversupplied markets means that there's more units than there are people looking for apartments. And what you're going to do is you're going to want to cherry pick and buy some of the Class A assets in those markets if you can.
Now, how would you know if it's an oversupplied market? I'm not quite sure how you would know this. I mean, in the only way that I can think of right offhand is just that the rents would be falling a lot. And there would be a lot of rent concessions because there's too many available apartments. Maybe, yeah, I don't know. Maybe if there's a website or anything that you guys know of where you could find something like that, let me know. I would like to look into something like this, but I guess making relationships with brokers, maybe that's how you would find that out. But, I'm not sure there's really maybe there is a place to go where you can find this out. It's maybe how many units have been built over the last X number of years versus how much the population has grown or something like that. But I mean, obviously oversupplied markets, if you can buy Class A, because that market's not going to be oversupplied forever because they probably stopped building now that they have so many units. And then that's going to lag and then it's going to pick back up. So, but anyway, I'm just curious, how would you find out if the market's oversupplied or not?
But the risk, of course, is how long will that market be soft and how long will it be in that condition? So that is a short-term risk, but it could be a long-term gain. So remember, this is a year to still stay conservative, but you need to be a little bit aggressive. You need to buy under the market, buy below replacement cost, stress test your deals like crazy, and model for flat or falling rent. On the other side of that, I can assure you that you are not going to see lowering expenses. So if anybody at any time is telling you can buy anything and it's going to run less later, run. I'm telling you right now, operating expenses are going up. We have over 10,000 units. We're fighting this tooth and nail, just trying to keep our expenses under control. And we're getting,
I know that I harp on the pro forma thing, but it's such an essential part of how people come up with the valuations of their properties. And I constantly see them lowering the expenses in the pro forma from the actual numbers. And I always wonder, how do they think that these numbers are going down? Expenses do not go down. They always go up, especially when you're considering, and then they won't increase like the insurance rates or the property taxes, and then they'll reduce the repairs. I'm like, that's not realistic at all. The insurance, as all of us know, the insurances have been going through the roof like crazy. They're going to keep going up. The property taxes keep going up, and the cost of repairs, because there's labor and there's materials involved, that cost is going up too. So don't ever believe the bullshit that the pro forma is telling you about the expenses. They're probably leaving out tens of thousands of dollars that you should be putting back in there. And so it's just one of the ways that they try to trick you, and don't let them do it.
Hit with things like insurance and utilities and payroll and property taxes, and all of those things are just absolutely battles. So make sure you budget accordingly for expense growth as well. So many of you know that we've done over 600 million in transactions this year. That's not even including some of the recaps, some of the new developments, and even some of the refinances that we actually did this year. So we're still fine tuning our plan for 2026. We think we're going to have a very similar year in 2026 as we did in 2025. But right now, we are also sniffing out which markets we want to be in, and we're building our broker relationships as we speak. So one of the things that we think is that people are definitely running out of cash, and we're going to see more and more listings in the late 2025 and early 2026, which of course is going to be great if you're trying to buy these assets and clean them up. So we're still going to focus on the same things we've been doing before. Obviously, if there's any value adds, we'll buy those. If we can buy below replacement cost and it cash flows, we'll buy those. All, of course, with fixed rate debt. And then in some markets, we might even break ground on some more properties because, of course, we're going to want to open those in 2027 and 2028 when the supply has fully absorbed and there's no new units coming on the market at that time. So 2026 is going to look very similar to 2025, where we're probably going to buy somewhere between 4 and 7 deals. I would guess probably on the higher end of that, depending, of course, on the price, the market, the interest rates, the cap rates, and all of those things. Of course, all of those things have to be aligned because we're not going to just buy to buy. We're going to buy if it cash flows today, because if it cash flows today, it'll cash flow tomorrow. So if you guys are an accredited investor and want to see the exact deals we're buying right now, of course, in strong markets with solid cash flow and tax advantages, just click on the link below. So the
little plug there. So good advice. I like a lot of what he has to say there. I think, he's given some pretty solid advice. Yeah, some of it's a little, high level for people buying large properties and who are building and, some things like that. But overall, good principles, good mindset. This is what you're looking for. This is what you're hoping to get. This is what you should keep in mind. And this is how you should think about these deals. If you guys have any comments for me, go ahead and put them in the comment section. There's a live chat. So, and I'll look at them and I'll answer if you have anything for me. If you would like and subscribe to my channel, that would be great. I will go live a couple times a week, and I'd like to have some interaction. I would like to get some feedback from you guys. I would like, if you have a deal in mind or you have an area in mind you want me to do a buy or burn on, I would be happy to do so. So send me your recommendations. You can just comment on this video when it gets put up, or on any of my videos. I read all the comments. So if you have anything specific that you want to ask, or if you want to call in, I would be happy to talk talk to you on the live, and we can have a chat, and maybe if you've got a deal, we could talk about it. Yeah, so 2026 is looking like a promising year. We'll see what all happens and what we can do and what kind of deals we find. I'm going to continue to be doing buy or burn and keeping an eye on the market and teaching you guys how to read these operating memorandums, and so that when comes time for you to buy and comes time for you to find a property that you want in an area that you want, that you know exactly how to read all the financial information to see if the property is going to make you money, because that's the whole goal. That's the whole point of investing, is to make money. And so that's what I'm hoping to help you guys do, especially in 2026. So, all right. Well, that's all I have for you today. I appreciate you guys joining me. This was fun. I'm glad Ken had some good advice for us. Looking forward to 2026. Hopefully I can find a deal. Wish me luck. If you guys have anything you think might be a good deal that I might be interested in, send it to me too, so that I can take a look at it. I'm mostly looking to buy in the Midwest. And so, but also I'd consider maybe Florida. So if you come across any deals that you think I might be interested in, send them to me, please. So anyway, I hope you guys have a good new year. Hope 2026 started off well for you, and you have a good, solid year. And hopefully we can make a bunch of money in real estate this year. All right. Thanks, guys.